Well, is it true? Did I really whip the market's ass for 22% in 2024 with the whole stack in play? Yes, I did. Hey everyone, I'm bobhedding, and in this video, I explained to you how I did it. Spoiler, it wasn't exactly a Sunday afternoon picnic. The journey actually began over 50 months ago. I was highly skeptical I could pull this one off. The goal was to apply my skills as a successful poker player to investing. Was it the perfect plan? No. And that's exactly why I liked it. I had taken a few college classes on economics, investing, real estate, but that was over 20 years ago. I had a few investments that did okay in the early 2000s, but then the great financial crisis hit and got wiped out. Finished. So from my financial background and history in investing, you could argue I had zero edge going into this project. Unless, of course, you consider failure an edge. The first thing I immediately found similar between managing money and poker is it's an absolute bloodbath. With poker, I cranked out a win rate of over 65% during a 10-year stretch as a cash game specialist. But that doesn't mean I didn't get the ever-loving crap beat out of me over 30% of the time. Plus, studies showed that losing hurts twice as much as winning feels good. Welcome to poker, my friends, a hard way to make an easy living. When transitioning to investing, I started reading some powerful books about the titans of finance. A Man for All Markets by Edward Thorp, Misbehavior of Markets, Benoit Mandelbrot, Other People's Money, John Kay, Trillions by Robin Wigglesworth. In Gregory Zuckerman's book, The Man Who Solved the Market, you hear the story about Jim Simons, the most successful investor of all time. Might want to read that one. Since 1988, Jim Simons' flagship Renaissance Medallion Fund averaged annual returns of over 66%. That's 66% on average, every year, year after year, over a decade, closer to 2 decades. That's your average. That is earmuffs. That is unfarging believable. I have been told my whole life you can expect 6% a year. That's a single 6 if you give your money to the professionals. I'm playing t-ball with my 6%, facing off against Simons, who's a 6'5", corn-fed Nebraska farm boy with a blazing fastball. I got a wiffle ball bat. Welcome to the big leagues, Mr. Heading. Plus, Renaissance was managing huge sums of money. If they start the year with a simple $1 billion, which I might add is 1,000 millions, 12 months later, the fund now has 1,660 million, with the ability to go back year after year for another puff of the cigar. Zimmerman's book claims Renaissance profits over the years are in excess of $100 billion, or 100,000 millions. The GOAT. Any questions? Didn't think so. The other learning tool I used that was highly useful was pro-to-pro conversations on YouTube. These were not cupcake interviews with softball questions from the uninitiated. Admirable, but ineffective. I wanted spirited conversations between a currency expert and a gold permabull. The permabull debating the crypto hodler, the hodler talking with the bond trader, the trader and an economist, the economist and captain stock picker, and the captain versus the full market investor willing to go anywhere at any time. In the beginning, I watched 150 to 200 pro-to-pros. I treated it like the Game of Thrones. Who are the most powerful players? Who are they talking to? And what are they talking about? There was Brent Johnson and his milkshake theory. Jeff Snyder on banking and the Eurodollar. Mark Cohodes, world-renowned investor and short seller. Mike Green with Tier 1 Alpha. Michael Taylor, Steinbommer, to name a few. It took months, but then I finally found a coach that complemented my skill set. He had played the game at the highest levels, and continues to play the game at the highest levels. He lays out the playbook right there in front of you, which he built based off his own beats over a 25-year career. The first piece of the puzzle is volatility, understanding it, accepting it, combining it with price, and then using them together to help you find the high percentage bets. Price alone does not give us enough information. We increase our odds by plugging in volatility into price, the way a poker pro factors in both hand strength and position to adjust the variable risk. Let me show you how and why in a game of No Limit Texas Hold'em. It's been said that poker takes a few minutes to learn and a lifetime to master. To begin the game, every player receives 2 cards, which only they can see. The strongest starting hands include big pairs and high-suited connectors, like kings, queens, and ace-king suited. The weakest hands are unsuited. They don't connect and are low. 2-7 offsuit, Jack-3 offsuit, for example. Then there is everything in between. 5-6 suited, Queen-10 offsuit. Let's take the exact same hand in 2 different positions. Ace-8 offsuit. It's not much to look at when facing 8 opponents in a game of poker. The cards are too far apart to make a meaningful straight. They are unsuited, which substantially degrades the flush value. The lone 8 is one of my least favorite cards to be paired with my ace. A pro could argue that this is a snap fold every single time under the gun with 9 players at the table. Yet that same pro could argue that ace-8 offsuit is a raise every single time in that same 9-handed game when you are seated on the button position and everyone folds to you. The very same hand played the exact opposite way every single time once position is factored in. Are we clear? Crystal. It's so simple when you look at my database of over 1 million hands of online poker. There are 9 different positions at the table. Where is the money won and lost? Of course, I won the most money on the button. I actually lost money in 2 positions, the small and big blinds. These are the only 2 positions you are forced to put in an ante before you see your 2 cards, which is not advantageous. So the blinds suck, and the button is awesome. And then, counterclockwise around the table, I won the most money in the positions closest to the button. I won less and less money the farther I moved away from it. It looked like this. Button, most profitable. Cutoff, second most profitable position. Hijack, the third most profitable position. Low jack, the 4th most profitable. The pattern continues. Under the gun +2, under the gun +1, and then the 3rd worst position at the table, under the gun. Not an unjust title. It's hard to turn a profit under the gun. You have to have the discipline to fold a lot of mediocre hands like ace-8 offsuit. Whereas in the next example, you are on the button with ace-8 offsuit, and every player folds to you. Now the only players left are the small and big blinds. Psst. The only positions at the table where all poker players, including seasoned pros, lose money. Now that big fat ace you're holding isn't looking too shabby. Who cares that it's with the 8 of pukes? I'm in position. I raise every time. Hand strength plus position gives the advanced poker player the edge. Price plus volatility helps the investor find the high percentage bets. Prices change unpredictably, violently, especially for the worse. For this reason, we want to be able to identify our risk parameters on an investment we're about to make. That way, when you do buy something, you have a general idea of what you're getting yourself into. If I invest $1,000, are we looking at a potential 3% swing? 1,000 could turn into 1,030 or 970? Or could we be in store for a 50% swing? Our 1,000 could look like 1,500 if we win, or 500 if we lose. The 4 main categories you need to understand are currencies, commodities, equities, and fixed income. Each of these categories have differing levels of volatility. We will position size our portfolio accordingly. Category 1, currencies, these have the lowest volatility of the 4. For this reason, we can have our biggest positions in currencies, up to a 12% max. Plus, you can have multiple positions. I could have 12% in UUP, 12% in GLD, and 12% in AAAU. And as quick as that, you will have 36% of your stack in play. This is not actionable intelligence. Stand down. Just an example. Category number 2, commodities or crypto. These have the highest level of volatility. Up or down 15% in a day, that's when you're not getting squeezed. What's your action plan if you own something that is down 30% on the week? That's some serious volatility, dog. In a 17-year bull market and a monumental crypto run, not many of us are prepared for risk managing a downswing. The playbook has a strategy. Position size our riskier commodities or crypto at a max of 4%. Volatility adjusted sizing. It's a safety mechanism to help protect your stack. Still, though, there are times I could have 5 different commodity positions, maxed out at 4%, and now all of a sudden I have 20% of my portfolio dancing. Category 3, equities. Max size in each individual equity, 6%. Look at the graph. Equities have the potential to go up and down more than the safer currencies, but not as extreme as the commodities. 6% is a nice place to be. Finally, category 4, fixed incomes. Max position, 10%. Shore up your flank with some of the lower risk bonds, HYG, IVOL, TLT. Again, not actionable. We'll get to that. Why is this a good strategy? Because we are all degenerate gamblers. Not always, just when we are losing. You've heard of being on tilt? Daniel Kahneman and Amos Tversky found that if someone has a choice between option A, getting a free $100, or option B, a 50-50 chance at winning $200 or getting nothing, they choose the free 100. Makes sense, don't it? Then explain this. If the same person has a choice between option A, offers a 100% chance of losing $100, or option B, a 50% chance of losing $200 or losing nothing, they choose option B. Our behavior changes when facing losses. Don't bluff the player on tilt. In 2024, I probably held between 30 and 50 different positions on any given day. Longs and shorts. Take it from someone who used to play 9 tables of online poker simultaneously. The human brain can only decipher so much information. 30 to 50 was the right number for me. Now, how are we going to be moving our money around? When we buy a security, how much will we be buying at a time? Let's say I have 50 separate positions with 1% in each. So I have 50% in play and 50% on the sidelines. If we see a buying opportunity in a currency, for example, do we just take this hot tip and scale our position up to 12% all at once? Push all in? I don't think so. The answer is incrementally, small pieces at a time. 50 basis points. That's a half of 1%. You can scale 25 basis points at a time or go as high as 1%. You are buying low and selling high over and over again. This is not a diamond hand strategy. The hodler would not look kindly upon this system. But remember, this is a strategy devised to protect wealth first and foremost. These tactics help you control your volatility of your portfolio. It wasn't just that I earned 22% in 2024, it was how I did it. If I was down 50% mid-year and then was up to close the year for a 22% profit, I'm not making a video advocating this system. That's not fun volatility. Frankly, it's unprofessional. Now let's stick the landing, the overall market volatility. I pay particular attention to the ticker VIX. The VIX measures market volatility. The MOVE Index measures bond volatility. The VIXN measures NASDAQ volatility. And the GVZ measures gold volatility. Coach McCullough has given us 3 crucial sets of numbers concerning the VIX. VIX 19 or lower is the investable bucket. Nice. Very nice. VIX 19 to 29 is the chop bucket. High-level money managers can get crushed here. VIX over 29 into the 30s and 40s, game over. I have to give it to you straight. It's called the fuck bucket. Earmuffs. If this fully operational investing system is sounding familiar to those of you with access to look inside a world-class hedge fund, it won't surprise you to see that it's a three-factor model that includes volume along with price and volatility. If a stock I own or was considering buying is going down sharply and then volume is continuing to increase, I'm in no hurry to buy this dip. Panic could be in the air. Wait and watch. Or maybe one of your investments has been on a 5-day heater, but now its volume has been decreasing and it's starting to flatline, maybe even making a series of lower highs. I'll probably be selling down my position, degrossing, build up some dry powder for an eventual dip, for example. I spoke earlier of actionable intelligence. 95% of my intel comes from one source, HEDGEYE. To begin with, they provide you with a quarterly outlook broken down into 4 investing quadrants. They are primarily determined using global growth and inflation estimates, but also factor in monetary policy. Once we understand what quad we will be entering, we can start to position our portfolio into investments that have a higher expected value in the upcoming economic environment. Let's look at quad 1. Growth is accelerating and inflation is decelerating. That's the best quad. Goldilocks. We will be putting our money in equities, credit, commodities, and foreign currencies. The best equity sectors are tech, consumer discretionary, services, and so on. Best equity style factor, high beta, momentum, leverage, mid-caps. The worst asset classes, fixed income, the US dollar. I love the US dollar. It's been good to me. But quad 1 is like being on the button in poker. You can be more aggressive. The US dollar won't give us enough juice. There's a flip side to that coin. Quad 4, deflation. That is where growth is decelerating while inflation is decelerating. Now as you cross-reference your high probability bets, you see the value has reversed. You need to reposition your portfolio for a potential bearish setup. The best asset classes are now US dollar and gold and fixed income. The worst places to be are in the riskier commodities, equities, high beta, momentum. Quad 4 is my entire poker career under the gun. I'm profitable. I make money. But it's the least profitable time for me to voluntarily put money into the pot. And I downsize my risk accordingly. Next, quad 2. Growth is accelerating and so is inflation, reflation. It isn't as good as quad 1, but it's still a favorable place to put your chips in play. Similar position to quad 1, but you add a few small caps, financials, and energy. Lastly, because I did these out of order, quad 3, stagflation. This isn't great. Growth is now decelerating and inflation is accelerating. Like quad 4, we have added lower volatility investments like fixed income and gold. You ditch credit, financials, and small caps. However, unlike quad 4, you keep commodities, energy, mid caps, and tech. So I spent a few bucks. In 2025, I bought a HEDGEYE package on sale for $2,000. For me, the must-haves include the macro show, hit the ground running, 6 a.m. This is a 30-minute power shift pre-market. Keith McCullough lays out the day's plan. What is the market doing, and how can we capitalize? ETF Pro. Here's the bird's eye, a list of over 30 quad-friendly ETFs and their trend ranges, which indicate where you buy and sell. Daily risk ranges, a list of heavy hitters with a tighter daily trade level, and whether they are signaling bullish or bearish trade. The list include ranges from the S&P 500, the Russell, the VIX, US dollar, gold, Bitcoin, oil, and you have gas. Real-time alerts. As the information changes, we change. The Asian market is open. The futures have spoken. The US market has been open for 30 minutes. Now what? In-game coaching. Data dependent. Can't get your broker on the line? McCullough is firing out buy and sell signals throughout the day. Finally, Weekly Portfolio Solutions product, showing Keith's current positioning in his long-only account. You're going to play your 60-40 strategy, 6% a year, see you in 30 years game against my ever-evolving quad matrix while executing high-probability bets and using volatility to help guide my strategy to invest in the short, medium, and long term? I ran into my old friend Ace-8 offsuit a few years back. I was invited to a private game in LA. Security cameras, armed guards, a double door system with a buffer zone. Got ID'd. Mr. Headings here. I sit down with 7 strangers, and in these stakes, I'm usually the best player, or one of them. The odds dramatically change when in walks one of the most successful poker players of all time. He's the 9th player. He sits right next to me. He crushed online poker for multiple millions. He played one of the biggest cash game pots in televised history, worth over $1 million. Most importantly, he was forced to take the last seat at the table, putting him on my right, which means I had position against him. So even though I accept the fact that I am now the 2nd best player at the table, since I have position against the best player at the table, I might actually be the favorite, factoring in that he didn't know who I was or my capabilities. Sure enough, 5 minutes into the game, and everyone folds to the 14th best player in the world, who raises. The first card I look at, an ace. The second, 8 offsuit. Now, there is no shame in folding here, but a call is a pretty terrible option. The player absolutely understands everything I know about position and hand strength. He will have deduced that he is sitting in the cutoff, where he has earned the 2nd most money in his career, multiple millions. So he will be raising a high percentage of his hands here in this spot, most likely hands worse than Ace-8 offsuit. He could be raising with Ace-5 or Queen-10. I would hate to be folding the best hand and losing value. The other bit of intel this top-level pro and myself both possess is that when he is in the cutoff with a marginal hand, there is only one thing he fears: the double envelopment. A re-raise pre-flop by the only other player at the table with position over him. I would love to sit back and wait for a hand like Ace-King or Queens and try to win money the safe way, but when you are playing poker for a living to put food on the table and pay rent, there simply is no time. You need to get in there and fight for pots. You have to be willing to die in order to live. I re-raise with the Ace-8 off. The small and big blind get forced out thanks to this springboard 3-bet, leaving their donations behind. The world-class player promptly lays down his now obviously weak hand, taking the initiative, applying pressure, using every tool at your disposal, including my anonymity. If he knew who I was or my capabilities the way I knew his, it could have gone differently. Sometimes in poker or investing, it's not what you know or what your opponent doesn't know. It's what you know they don't know you know.